YouTube, what it do? It's your boy Little Petty dropping in with you guys with some stock market lessons. Alright, you guys, in these ones we're going to talk about, this is probably going to be a two-part video series. I might drag it on, but we'll see how it goes. But in this series, we're going to talk about how to sell options in a small account for income. So we're going to actually talk about options. We're going to go over, we're going to give you guys some details. So make sure you guys stay tuned, like, share, comment, and subscribe if you're new. All right, so let's get right into it. I have my notes ready to go. This is going to be a good lesson. So make sure you guys stay tuned. Now, this video is going to be beginner friendly, so we're going to talk about a little bit, what options are. This is going to be kind of more of a beginner friendly video. So let's jump straight into it. All right, so what are options? So the definition of options are basically the right to buy or sell a stock at a certain price at a certain time or date. So the definition is right here. A stock gives the investor the right, but not the obligation to buy or sell a stock at an agreed price and date. There are two types of options. There's puts and calls. Now, puts are a bet that the stock is going to fall, and calls are a bet that the stock is going to rise. Now, if you guys want to get into more details about what options are, I'm going to breeze through this, but go to YouTube, type it in, what are options. If you guys want to do a 30-minute lesson on that, get that information. Now, how do they work? We kind of already talked about it. Calls, they go up. When the stock goes up, calls, they rise because we're saying that the stock's going to go up. And puts, when the stock goes down, we make money by holding the puts because we're saying that the stock is going to go down. So we have a bet saying that the stock's going to go down. So let's go ahead and jump into the option chain, and we can show you right here on the right side is going to be your puts. So you have your strike prices and you have your strike dates. This is the option chain. So this is the option chain for TTD. You see we have multiple strike dates. So these are the dates that the options are going to expire. December 18th, 24th, yada, 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 so on and so forth. And we have strikes on calls and puts for both sides. So we're going to get into all of this stuff. So I just want to show you the option chain. Some stocks have options chains, some stocks don't. So that's going to be key when you're looking at penny stocks. They don't have options. All right, now what are some of the advantages in options? So some of the advantages in options, for one, is that we actually can leverage our money. So we can leverage our money. We can trade these. We can do spreads. That's what we're going to talk about in this video. We're going to talk about how we can actually come to the option chain and take advantage of selling calls or puts out of the money so we can collect premium. We're going to get into that. And the options are basically, it gives you a right to, it's basically a contract saying that you have the right to own these shares at a certain price, and as the stock is going in your favor, the option premium is going to go up with the stock, so you make money by holding the option. So for instance, if we had this 365 Tesla call that we bought for $23, this contract would go up if Tesla continued to go up. Now, those are just a few advantages in the options. We could talk about a little bit more, but we're going to talk about a couple other things in the options. So we're going to go ahead and talk about how to trade calls and put. We're going to talk about how to trade calls and put spreads and debit spreads and credit spreads. We're going to get into that. All right, so for the people that are a little bit more seasoned, we're gonna we'll go ahead and jump into a chart so we can get some visuals. So the first we'll talk about. Let's see real quick. And this video is gonna be cut raw. You guys all know I record my videos. I do not edit them, so you guys are gonna have to bear with me. All right, so how to trade call and put spreads. All right, so let's talk about first a credit spread. So a credit spread is basically, let me give me 1 second. I'm gonna pull this up. Small account, Little Petty, right here. There we go, right here. The credit spread formula. All right, so a contract short minus a contract long equals the credit received, and that's going to be your max gain. Now, the strike with minus the credit received is going to be your cost and your max loss. So let's break this down because that just sounds like a bunch of gibberish. So when you come over here to the option chain, when you want to sell a credit spread, that's basically saying that the stock, you're going to want to sell a credit spread outside of the money. So let's talk about in the money and out the money real quick. So let's go ahead and we'll pull up Apple stock. We'll keep it simple. Oops. AAPL. And we'll go to the daily chart. I will go to the hourly chart. And we'll go to the daily chart. All right. So Apple stock right now is trading at 127. That's the price that it closed at. It opened up today at 124 and it ran up to 127. So go ahead and go to Apple, AAPL. Now when you come over here to we'll start with the closest strike. So the strike that's going to expire on December 18th. Now when you want to do a credit spread, when you come to Apple, you're basically saying, so the price of Apple right now is at 127. So any of the calls, so let's go to the option chain, the calls, anything that's above 127, these calls are going to be out the money because the stock price is not at the strike. So when the strike, so for instance, this 128 is out of the money, this 129, this 130, but this 127 is in the money because it's actually in the money. This 126 is in the money. This 125. You guys get the drift. Okay. So when you're selling a credit spread, what you're going to want to do, what you're saying is, I'm going to sell an option out of the money to collect the premium because the time decay on these contracts, if they don't land in the money, they're going to go to zero. So for instance, if you're going to buy a call, you would just basically come over here, go to the ad, say I want to buy this call. This would be a buy. You're going to hit review, send, you buy a call. You're holding this strike. Now you can actually sell these calls or puts. So a credit spread is basically saying I'm going to sell a 127, or say I wanted to sell a 124. That expires on Friday. I'm saying Apple stock's not going to come below 124. We have a support level down here. We bounced up out of here. I want to sell a 124 put out of the money, and by the strike date, December 18th, if Apple stock is not at 124, if it's not trading at 124, if it's higher than 124, I get to collect all that money that I basically sold because that contract's going to go to zero. I sold the contract to somebody and I'm going to collect it. So what you do is you're actually going to sell the contract. So back to the formula. The contract short, that means the contract that you sold minus the contract that you buy, because the spread is basically saying I'm going to sell this naked, but then I'm actually going to buy the outside leg, because the sell naked, you actually need, you need a bigger account. Because if it backfires on you, this can go below, this can go way past than what you owe. So you're basically collecting the premium. So this is how you set it up. You're going to put the contract short, and then you're going to buy the contract on the outside. Now you can adjust the width and how determining, oops, let me pull that up. Determining the width, the strike width minus the credit that you receive is going to be your max loss. So let's keep it simple again. Back to, we're going to sell the 127. So if we were to sell the 127, we're saying that Apple needs to close above 127. It needs to continue its bullish run, and it needs to close at 127 or higher by the strike date. Now the width is going to be the width of the legs. So you have your sell, your contract short, and your contract long. Now if you were to minus these two in between, you would actually get the credit received right here. So when you're selling options, you're actually collecting this credit right here, but you have to have a balance to collect this. So the balance is going to depend on your width. So if you were to sell one leg, let's go ahead and pull out the calculator and break this all the way down. All right. So you sold this 127. The ask is at 112 and the bid is at 109. So if you do 112 minus 109, that's going to give you a $3 midpoint. So they're going to take the middle of this, so it's going to be about 110. And then if you buy this, this is going to be the middle point of this between 75 and 77 is going to be 76. Because they're going to try to fill you on the average price in the middle. That's what the market makers are going to do. So what you're going to do right here, I'm going to break this down how this works. So the middle price of 112 and 109 is going to be about 110. 110 minus 76 is going to be that 34, and that's the credit right there that you're going to receive. So if we were to take this width to another level, now we have a 2 width. Now we have the strike between 127 and 125. That's 2 widths right here. The strike width is 2 now, minus the credit received is going to be our max loss. We haven't got to that point, but we're breaking it down. All right. So now you have your width of 2 right here. Same formula. 110 minus the middle of 152 and 151. So we'll just put 151 or 51. You're going to get 59. Boom. Now that's the credit you're going to receive, $59. Now the width is 2 points. So 2 points minus $59, well, 0.59, that's going to be $1.40. So that's how much your capital you're going to need to collect this $59 as long as Apple closes above the strike that you sell. Now you can sell in the money, but we don't recommend to sell in the money. We actually recommend to do a debit spread so you don't have to close out the trade if the trade doesn't get to your strike price. We'll get into that in a little bit. So that's basically breaking down a credit spread. Let's go through it so we can get a clear understanding. So Apple stock, boom, is trading at 127. We're saying, okay, by Friday, or say we even want to go farther out. Now the thing about going farther out, you're actually going to be able to collect more premium because the time on the contracts are going to be higher because they have more time. So like I said, if you guys want to do the whole option thing, if you want to really learn options, you're going to have to, it's more than just, calls and puts. Like this is just like a grasp of giving it to you, but this is more of teaching you how to sell options in a small account. All right, so say if you were to go out here, you can see you're probably going to collect more premium. So on this one, you would collect 45 cents, 24 days out. And over here, you're going to collect 34 because these ones are more than likely going to decay fast. Well, they're going to decay faster because they expire sooner. So that's going to be the less of the premium. So Apple is trading at 127. We're saying, okay, we don't think it's going to close below 124. We come over here. We sell this 124. We buy this leg right here. We can collect this $10, and we need a risk of $90 to collect this money. Now, obviously, it's not a lot of money because these contracts are more than likely going to expire in the time. So say we wanted to sell right up closer, we would actually be able to collect more money right here, $34, and our max risk would be $66. Now, with the width is your max gain possible. So if you were to sell up here, you would collect $85 and your risk is $15. Now that's not saying you could do it as a debit spread though on the other side, which we'll get to, but this is basically saying the width and the option that you paid for, that's the max gain. So the max gain on a $1 width is going to always be $100. A $5 width is going to be $5. A $10, $10. So that's going to be the max that you can collect. 10 it times 100 is 1,000. So understand that the width is important. If we do a 1, 2, 3, 4, the max that we can collect is $76. We're going to need $224. Boom. And that's gonna actually it's 3, and that's gonna equal $300 max gain. Max profit right here is 76. We put up $224 collateral. That's the most we can lose is $224, and the most we can gain is $76 by December 18th. All right. That was a full breakdown on the credit spread formula. And we are at 15 minutes. All right. Now let's go ahead and talk about the debit spread. Now, the debit spread is the contract long minus the contract short, and that's going to equal your cost and your max loss. And the strike width minus the debit paid is going to be your max gain. So now on the flip side, a debit spread is going to be the opposite. Now we're actually going to buy this 127 and we're going to sell this 128. It's still a bullish play. We're saying that the stock is going to go higher. So if we wanted to do one out of the money, so if we're bullish on Apple, so back to the chart on Apple. If we're bullish on Apple and we think that Apple's going to get to 130 by Friday, a play that we could set up is come over here and say, okay, we're gonna actually sell the 129s and we'll buy the 128s. Now, when this actually gets in the money, we pay the debit of $42, and our max gain is going to be 42 minus 100. It's $58. So if Apple stock was to actually close above this strike that we sold, 129, so we actually we actually left room for the 130. If it closes above, we will walk away with that $58 profit by Friday. So that's the flip side. Now if we were to widen up our width, same thing. Now it's $74 to put on this trade, and our max gain is going to be 200 minus 74, $126. So if Apple was to blow past 130 by Friday and we put on this debit spread, we paid $74 to hold this contract. And if it blows past there, then we would walk away with this I keep closing out the calculator, with that $126. So 200 minus 74, $126. All right, so when is it time to do a credit spread and when is it time to do a debit spread? A credit spread is more, we're trying to sell something farther out of the money, because, so for instance, some of the credit spreads that I like to do, I like to come out to the next following week, and then I would sell, an option around, let's see the delta, probably around like 30 and 28. And you're usually going to get a fill of about a 72 probability, 69, 65. So sometimes I do like to go closer if I'm bullish on the play. 60% is good. And then if you want to do an in-out is always good for a debit spread too. And that's where you get at about 50%. And then you can do just basically where you can, we'll talk about that later. We'll get into the all that stuff later too. All right, so I feel like, let me see, debit spreads, how to trade call puts, debit spreads, credit spreads, how they work, and how spreads options. All right, so this video is already 18 minutes. I'm gonna go ahead and cut this video off. We'll go ahead and run another video on how to sell options in a small account for income, and let me know if you guys like this. I will go ahead and talk about, we'll go through that list, and yeah, so that's it for this video, YouTube. I hope you guys liked it. Stay tuned for the next video, and Little Petty is